So, what does an inflation miss and an increase in interest rates mean for house prices? Well, markets priced a fall, and in fact, we got a stall 8.7% year over year and no change month on month. Now, the worry actually is that core inflation increased, and this led to the Bank of England raising rates to 5% from 4.5%. Markets went further and priced hikes of 6% in Q1 of 2024. Now, why 6% is interesting is because the Bank of England published this in a stress test themselves last year. They said, and I quote, UK bank rate is assumed to rise rapidly to 6% in early 2023, before later being reduced gradually to under 3.5%. Now, under this scenario, the Bank of England goes further and states, and again I'm quoting, UK GDP contracts by 5%, unemployment more than doubles to 8.5%, and residential property prices, are you ready, fall by 31%. And we would expect rate hikes today to have some effect on house prices in roughly 8+ months' time. That's about the lag time. So what are we doing in this video series? Well, we don't talk news, noise or headlines. We look at UK housing market leading indicators. So those are indicators that move long before house prices so that we can stay one step ahead of the price curve. Before we have a look at what's in store for house prices, let's have a look at them up to date. So let's kick off with the most timely, which is the Rightmove Asking Price Index. So that's the average asking price of all newly listed properties on Rightmove, and this is for the period of June. So average asking price of 372,000 and change. That's a monthly change of 0.0% and annual change of 1.1%. So flat month on month, still showing a very small positive annual change year over year. Next up, we'll look at the mortgage lenders. So that's both Nationwide and Halifax. Let's start with Nationwide. So for the period May, we've got 260,000 and change. So that's down 0.10% month on month and down annually 3.4%. So between May 2022 and May 2023, showing a 3.4% fall. Next up then, Halifax for May 23, 286,000 and change, another flat month-on-month change or no change and showing annual change at -1%. Move on to the two what we call official figures, that's the Office for National Statistics and the HM Land Registry, which is of course sold prices. So we've got the Office for National Statistics, both of these taken from the same report, which is why they look like the same number, 286,000, up month on month at 0.4%, which is the seasonally adjusted number, and showing annual change of 3.5%. Next up, the Land Registry, again for April, this is lagging, as is the ONS, 286,000 and change, again, all derived from the same data, up 0.5%, so unseasonally adjusted, if you note here the ONS, 0.4% seasonally adjusted, and again showing the same year-over-year growth at positive 3.5%. All right, let's go. We've jumped over to our dashboard of leading indicators. First up is mortgage approvals. This will look familiar for anyone that's been following along from the start. Now, we've plotted this twice. We've got mortgage approvals overlaid with year-over-year sold prices. And in this chart here, we've got mortgage approvals overlaid with year-over-year changes from Nationwide. Just very quickly, if this is new to you, you can see the mortgage approvals in blue overlaid with the red line, which is the year-over-year change in house prices. So every positive move in mortgage approvals, we see with a lag, a positive increase in year-over-year change in house prices. The same is true in reverse. So what's the latest data? So you may well remember this graph from the last video. All we've done here is we've plotted mortgage approvals from their peak in November of 2020 all the way to present day, picking out in red the months where we've seen mortgage approvals actually going up. And that trend has not continued. We'd see a blue bar here as the latest data for April is 48,690, which of course is a month-on-month fall. And as we can see better illustrated here in this chart, whenever we see falls in mortgage approvals, year-over-year house price growth is typically, usually, always negative, but with a lag. Falls, therefore, in mortgage approvals means further falls in house prices are significantly likely. So that was leading indicator numero uno. Next, we're going to take a look at gross secured lending. This is a fantastic and again, very, very timely indicator for price moves in the UK housing market. So why are we looking at this? Why is this of interest and what does it mean for prices? Well, we know liquidity is key, but it's mainly down to its lead. We get a peak here in November of 2006, a full 13 months before we start to see price falls in 2007 in the 2008 GFC blow-up. We also get a second reading here in June of 2021, a high before what we've seen as price falls continue after August of 2022. So it gives us a very, very timely read on prices way before prices move themselves. So it's given us two very accurate reads on prices before they've moved themselves. This is why it's made it onto this dashboard here. However, you can see it very smooth up until around this COVID period where we saw lots and lots of volatility. In this graph below, all I've done is try and in an attempt to smooth that out, just create a rolling 3-month average. And that's just helped smooth out all the COVID volatility where you can hopefully view this slightly easier. So to summarize gross lending then, if we see falls in gross lending, we can expect house prices to fall in about 12 to 14 months time, suggesting then that UK house prices could continue to soften for quite some time from today. And this is backed up in the next tab. We've said liquidity is key, but when we look at gross secured lending, it gives us a very good read of prices to come. But what about net secured lending? Well, I've graphed it here and it's very, very telling as actually for the first time in this whole data series going back to the early 90s, have we ever seen 2 consecutive monthly negative falls in net secured lending. So hopefully that's made the point of just how significant that is. And in fact, in 2008, we didn't even see any negative changes in month-on-month lending of net secured lending. So just to show you quite how brutal things could come in the next 12 months for prices. So we have to next have a look at average real weekly earnings. So weekly earnings from the ONS adjusted for inflation. Now, average weekly earnings are such a key driver to the housing market. When we see them going up, house prices go up. When we see them go down, house prices do the same. So when we're seeing them flat or coming down off those COVID highs, it's no surprise we're seeing a softening in house prices. Nothing much to report here. They've been pretty flat since about October of 2022. Next up then we have to look at real M4 growth. M4 growth ties in very, very, very well to real average weekly wages. And in fact, I always pick out the 3 same bits from the graph here. You'll see the 1990 house price crash, the 2007-2008 GFC, and possibly what we'll call this the COVID crash or the post-COVID crash. Now, actually, this is lower than we saw in 2008, which was again lower than what we saw after the 90s blow up. So looking at real M4, we get a very timely indicator of what's likely to come with prices 6, 12, 18 months down the line. And in fact, a falling real M4 growth rate is very, very bearish for prices. So similarly to mortgage approvals, gross secured lending, net secured lending, a falling real M4 growth rate is a massive headwind to UK house prices. Next up, we have to talk mortgage rates. Of course, affordability is a huge, huge factor. A huge tailwind for the UK housing market is, of course, prices of mortgages coming down, making it cheaper, making those mortgage payments much more affordable. Well, of course, the reverse is true. As mortgage rates go up, this eats into household affordability. Of course, that needs explaining to absolutely no one, but why this month is significant, because it marks the first month since November or October of last year where we've seen an incremental month-on-month increase right across the board. Now, this wasn't really news to us because, of course, we saw the telltale signs, which was swap rates pushing north. Swap rates going up is the reference rate for fixed price mortgages. So that continued squeeze as swaps push higher back to almost where they were in the Liz Truss era. Of course, that's going to continue to put the squeeze on UK household finances. Feeding off of mortgage rates then is the 5-year mortgage spread. Slightly more telling, as this shows us banks and financial institutions pricing risk into the housing market. So this is the difference between the risk-free rate, the 5-year bond yield, and the 5-year fixed mortgage rate advertised to households. We've backed the spread out and plotted it here. Now, luckily for us, this is pretty simple to read. Low and falling, house prices generally see good growth. High and rising, house prices soften and crash. So where are we at now? Well, it's actually come down, and it's come down a lot to a very, very historical low. So is this banks telling us that they're pricing not too much risk into the housing market? Yes, there could be some issues in the wider economy, but are we being told here that banks don't think that will spill over into defaults? It is most certainly one we will have to keep our eye on. Now, we can't talk house prices without talking supply and demand. And here we've got a bit of a homebrew metric, which is from RICS. It's the new bar inquiries plotted with new vendor instructions. So we've took new bar inquiries as new demand, and we're taking new vendor instructions as new supply. Both new so we can get the most timely data as we can. Now, as we've said, you can't talk one without talking about the other. So what we need is the spread, or the difference. And so in this graph down below, we've got the supply and demand spread. So here we can see the latest reading in May, firmly planted negative. So supply is up relative to demand, and demand is falling relative to supply, which is increasing. And this is exactly what we thought we'd see way back last year. We talked about this period here throughout 2021, where supply was very, very low and demand was exceptionally high. We began to form a bias that we thought this would start to unwind as this data spread started to come down. In fact, the exact thing happened. We saw demand fall off a cliff and supply start to rise pretty steadily. So low demand, high supply, it's not looking good for prices. Yet another headwind for UK house prices. Now, we could have this bias backed up if it was manifested with some data showing exactly that. Well, that's exactly what we've got here with Rightmove reductions. When we had very, very, very high demand and low supply like we had throughout 2021 and arguably the first half of 2022, we had very, very little reductions on Rightmove. Of course, when the tables turn, we've got very, very high supply, which is very, very difficult to shift. And of course, that's playing through in the number of reductions we're seeing for May, still at very, very elevated levels. So there's not really been much of a spring bounce, and in fact it's turned from a seller's market very much now to a buyer's market. So unlike 2021 and 2022, we're not seeing stuff on Rightmove selling for over the ask. We're seeing the opposite. We're seeing more reductions, which is going to put downward pressure on prices as they are forced to adjust. So that is the fifth serious headwind for prices to move down. Lastly, just to finish, I've taken the last 21 years worth of sold price data and isolated it just for the month of July. So what are we expecting to happen in the month of July in sold prices? Which of course we'll get the report on that in September. It's 2 months lagging. Well, of the last 21 years, we've actually only had 2 down months, so negative month-on-month moves. One you can guess is 2008, of course, the GFC, and the other you can probably guess as well was during COVID. So the likely move in July would probably be positive. However, if it isn't, it will be extremely significant statistically. So that's all for this video on UK property market leading indicators. We're going to check back in a couple of weeks' time with the latest data and see what moves we can infer in the future for UK house prices. Good luck.